In this series, we'll be diving into the ecosystem of crypto and digital assets and understanding every single layer from a Sharia lens. Understanding what are digital assets and are they Sharia compliant? In today's session, we're focusing on how to determine if a crypto or digital asset is Sharia compliant. And specifically, I'll be talking you through how at Facet we've developed a unique screening criteria and screening tool to determine whether a digital asset meets the Sharia principles or not. Then we shared the 5-level Sharia screening that we adopt and utilize at Facet, where we look at the base layer, the layer 2, the application, the token utility, and the token classification. And then we went through 2 examples of Filecoin and Solana. Join us exploring and explaining the Sharia principles of how to navigate the other areas of digital assets. Welcome to the Crypto Shariah Series. In this series, we'll be diving into the ecosystem of crypto and digital assets and understanding every single layer from a Sharia lens. So that includes looking at the digital assets themselves, understanding what are digital assets and are they Sharia compliant? What are the criteria? Then looking at staking in another episode, looking at liquidity pooling, looking at how decentralized exchanges work, looking at how yield farming, whether that's Sharia compliant or not, and likewise looking at many other things like tokenization and other ideas within the crypto ecosystem and cryptoverse. But in today's session, we're focusing on how to determine if a crypto or digital asset is Sharia compliant. And specifically, I'll be talking you through how at Facet we've developed a unique screening criteria and screening tool to determine whether a digital asset meets the Sharia principles or not. So let's dive in. In the first 15-20 minutes or so, I just want to talk through the major discussions, debates, arguments around crypto that are raised from scholars, and I want to present certain ideas on how we can understand digital assets from a Sharia perspective. What are the different ways to understand this and how can it possibly be Sharia compliant and meet Sharia criteria? So the first question is always, why is this important? Well, the reason why scholars analyze anything from its essence perspective is to understand whether that's a valid property. And hence, that's the central question scholars begin with. Is this a property, a valid asset from a Sharia perspective? The reason why this is a question is because we know in the prophetic narrations, the Prophet ﷺ, he prohibited trading gharar, speculative things which are uncertain. He prohibited the trade of ma'adum, something which doesn't exist. He prohibited multiple things in different narrations which effectively were all not existing. So any non-existing item which you're trading cannot be traded from a Sharia perspective. Why is that the case? It's because if you are entering into an exchange and what I'm giving you is not existing and you're paying money for it, then there's an imbalance here. I'm receiving money directly from you immediately, but what I'm giving to you, it doesn't even exist. You're not gaining anything. And the Sharia philosophy when it comes to exchanges and transactions is both parties must gain something. It's a win-win. I get money if I'm selling something to you and you leave with an asset. Or if it's a lease, I lease a property from you and you gain rent or fees. So the idea from a Sharia perspective is both parties always win together. But if you're trading something which doesn't exist, which can't be deemed to be property, then one party leaves that trade without anything material, without anything of substance. And that's unfair because he's parted with his wealth, but he hasn't gained anything in return when it comes to an exchange. Hence, the primary discussion scholars raise is this an asset or not? Are you actually gaining something or not? Now, there have been some views from scholars who have negated the idea of digital assets being valid property. And interestingly, in the UK, the Law Commission did the exact same research and study. Their conclusion was, and their recommendation to government and parliament was, that it does fit the criteria of property, but a third type of property. It's not the old traditional type of property that we are accustomed to, of tangible nature, where you can physically take possession of. But this is a different type of property. And the Law Commission then recommended that this should be deemed to be property, and hence a bill has been prepared which outlines that crypto or digital assets should be deemed property. The same analysis happens in the minds of Sharia scholars. That is this really an asset? Is this really something that can be deemed property or not? What I want to present is 3 ideas, 3 different ways in which it actually can, from a Sharia perspective, be deemed property. So the first one is the idea and concept that digital assets can actually be deemed to be mal. Mal is property from a Sharia lens. And just like we have mal and we have property, everything around me and everything around yourself, you're using this, you're benefiting from this. These are all assets. These are all properties. This is also a new type of property. Why are we making that judgment? It's because what is the definition of property? Like you can see previously on the slides, Ibn Abidin rahimahullah, he mentions this, that what's mal, the scholars write mal, which is property, is ma yamilu ilayhi taba', something which people naturally incline towards. Why do they incline towards it? Because there's obviously a utility in there. There's a benefit for them in that. And the second condition he mentions is وَيُدَّخَرُ لِوَقْتِ الْحَاجَةِ, that this mal and property or asset can be stored. It can be retrieved later. The scholars put this definition down so that it distinguishes itself, meaning property is distinct and distinguished from manfa'ah, which is usufruct and services. So if you're leasing a house, whatever you're leasing really is not something tangible or physical. It can't be stored and retrieved later. It's consumed as you use that thing. So that then excludes the idea of manfa'ah, usufruct, services. Likewise, huquq and rights are excluded because the scholars classically did not deem rights to be property, because property is something that can be transferred, it can be stored. Whereas rights rest in my conscience. I have this right and the ability to do something. I have a license, but it's not something tangible that I can show you or give you. I've been given a right. This was the classical way of understanding rights. And therefore, if I grant you a right, I'm not really transferring anything to you. I'm just permitting something for you to do. So scholars mention for mal, the idea of storability, retrievability was crucial to distinguish it from usufruct, services, rights, and also debt. Because debt was this intangible thing, and it's just an action, I owe you. It's nothing physical, it's just in my liability. It sits on my balance sheet. That's all it is. The scholars had this definition then to exclude all these other things. And so if that's the definition of mal, the 2 key conditions being that it has this kind of inclination, there's a utility to it, effectively. And number 2, it can be stored and retrieved at a different point. It has an independent existence from the human being. That's the core thinking up here. Then anything which fits that criteria or those conditions will be deemed mal, an asset or property from a Sharia lens. Hence, if that's the case of what is mal, digital assets absolutely fit that, because digital assets, they exist independently. They don't rest in my conscience. They are not used upon consumption like a service is. Neither is it a debt. Neither is it a right per se. It can be deemed to be a separate independent thing which is recorded on a ledger, and we are spending that thing. We are transacting in that thing that exists there, whether that's a code, a number, a file, a digit on a ledger, but it's something independent there, which can be retrieved later on, which can be transacted later on, which people have an inclination to. People want to use it. And that's why, when we look at it from this perspective, digital assets fit the criteria of mal under this idea. I'd also like to highlight that it's not a requirement, according to the majority of scholars, it's not a requirement for an asset to be something which is tangible or physical. So if we utilize this concept and understanding of what properties in Sharia, it's not necessary for an asset to be physical or tangible. In fact, Mufti Uthmani in his Fiqh al-Buyu', he very clearly mentions this, that Ainiya and being a corporeal or physical, tangible thing is not a requirement for something to be an asset. And he gives examples like gas, electricity, that's been accepted. In fact, we accept so many intangible things. We've accepted PDF files, ebooks, audible books, domain names. We've accepted applications on mobile phones. These are traded and sold. None of these things are tangibles. So the world has accepted, Sharia scholars, Sharia councils, Sharia people have all accepted the trading, transacting, the using of these intangibles. Hence, this is just another intangible when you think about digital assets, part of that category as well, which fulfills the criteria then of mal and property from a Sharia lens. So that's one view of how to understand digital assets. And that's if you accept the premise that an asset does not have to be tangible. If you're of that view that assets do not have to be tangible, or mal does not have to be something physical and tangible, then just like how we accept intangibles, we've accepted intangibles everywhere in our lives. In fact, even the IOP standards in Standard 42 on the discussion of Huquq Maliyah and financial rights, they even call the rights such as patents, trademarks, business names as intangible assets. And so even in the IOP standards, there's a recognition of this. In fact, the International Islamic Fiqh Academy, in the resolution 4243, they have also recognized these intangibles as assets. So this has become a global phenomenon, is something which is part of our life. So just like that is part of our life, and we've accepted this, this is just another addition to that universe of intangible assets. That's the first opinion. The second opinion, or the second route and method of establishing digital assets as being proper assets, is if you deem this to be a requirement that something has to be a physical asset for it to be mal and an asset, then there is still a way to acknowledge digital assets as being mal, which is mal hukmi. That although it doesn't fulfill the physical property test and the tangible test for mal, then it's still in that ruling because it fulfills the same criteria and condition. The whole point of having a physical asset is it can be taken possession of, it exists independently, it can be spent independently, and it's not you and it's not in your dhimma. That stands true for digital assets as well. We have a system which allows other types of assets to exist independent of this world, or at least in the digital realm and not in the physical world. But that is a world in and of itself, which has its own criteria, conditions, and its own frameworks to understand what is an asset, what is not an asset. And although from a classical scholarly perspective, there were very few scholars who held this view, like Imam Haskafi rahimahullah, the well-known Hanafi jurist who passed away in the 11th century of Hijrah, he was of the view, or he specifically mentioned in his definition of mal and assets, that something has to be a tangible, it has to be an ayn, it must have some corporeal, tangible entity for it to be considered. Now, even if that's the case, as I mentioned, the whole point of intangibles being accepted today shows that you can still have assets which fulfill all the conditions and requirements as physical assets, and we're deeming them to be assets. Hence the IFA Standard 42, the Islamic International Fiqh Academy resolution, just your practice and my practice and everyone's practice of utilizing digital assets, or at least digital software, digital goods, buying, selling online, buying domain names, having trademarks, all these things which exist digitally. We are buying and selling these things. So these are all what we deem to be then mal hukmi, meaning from a Sharia lens perspective, these are also deemed to be valid assets and mal, although they are not real tangible things like how classical scholars understood. So that's a second approach. Then the third way to understand digital assets, or from a Sharia perspective and approve it from a Sharia perspective and make it acceptable, is thinking of the concept of rights and huquq. See, classically, scholars debated on whether rights are valid tradable assets or not. Can they be traded? So we had multiple types of rights. For instance, there was famously mentioned in the books of fiqh is the haqqul murur, which is a right of passage. So classically, in a very early period, the scholars mentioned that this is not a valid asset, just having the right of passage in somebody's land. Can that be traded or not? So many of the scholars were of the view, no, it can't be traded. This is not an asset. It's just a right. And this thing can't be transferred to anybody. Therefore, it cannot be traded. However, when you look amongst other Hanafi jurists and later on, this develops then into an asset. It's recognized as an asset. Ibn Sama'a and later Hanafi jurists then mention that it is acceptable. Ibn Abidin also records this in his Hashia, that this is a valid, tradable thing. Because why is this the case? The scholars were objecting on it not being an asset because it was something which never had a system to capture it. It was not being traded, it couldn't be transferred, it wasn't being transferred as such. And maybe the question was just asked at that time. Its essence and reality was it wasn't deemed to be transferable. There was no system to record that transfer, to acknowledge the transfer, and then to maintain those rights. But as time progressed, this all developed and this became a thing. Hence, it was then accepted and approved because there was a system supporting this, and there was no longer any jahala, ambiguity, gharar, uncertainty, and nobody would feel that they haven't received something. Rather, everybody felt that if I'm transacting and trading and buying this right, I'm actually receiving something, and there's a system which protects that right of mine. And I have it exclusively, I can use it now. Hence, the criteria and properties of mal and assets were assigned to the concept of haqqul murur, the right of passage. And this is also the same with the concept of haqqul ta'alli. This was a right to build above a particular building. That right of building or the right to that space. In the earliest times when the scholars debated this issue, this was known as al-haqqul mujarrad, which wasn't a valid type of asset at all. It wasn't something that can be traded because how do you transfer that right? How do you capture that right? But later on, it became like right now in Fiqh al-Buyur, again, Shaykh al-Islam Mufti Uthmani, he mentions very clearly that it seems acceptable to now accept this because this is something which can be stored, it can be traded, it fulfills the criteria of mal, and the urf and the people's understanding is that this no longer results in disparity. It doesn't result in speculation, ambiguity. People deem something to be actually transferred because the system that we live in today, these things are actually captured in a system. They're recorded. There's a way to recognize these things. And that's why you can lay claim to an asset now because it's stored somewhere. There's a file, there's an online registration, perhaps with the authorities and the government, there's a registration there, which mentions this haqq and right. Hence, it's become a real thing. And this is the case with many other rights. For instance, haqqul shirb. There was the same discussion where initially the scholars of Bukhara, earlier times again, were of the view that it's not a tradable right. But then you look at the scholars of Balkh in another area. They mention it's acceptable because of the same ideas being found. Likewise, in recent history, there was a concept of haqqul qarar and other rights that were being traded where a person could pay a fee and have not only does he have a leasehold of a property, but he has that property and the right to use that property for a long term by paying this additional fee. It was a right that was granted to that person. And the scholars approve this, like the famous Ottoman Mufti and scholar Abu Saud, rahimahullah. He also approved this and accepted this. So rights have developed across the era. The main idea was, is there a method, a system to capture this and to make it like property? And once there was a system which developed in such a way, then scholars recognized these rights as something that can be traded, and that happened with the passage of time. And the urf and the customary practice simply highlights this reality. It shows us that the people deem this to be no longer speculative or no longer something which is not existing. Rather, it does exist. And when it does exist, it fulfills the criteria of being assets and mal. So these are the three ways which I just wanted to share when it comes to understanding how digital assets can be actually recognized from a Sharia perspective. Either number one, you say it's mal and property, because property doesn't really have to be tangible according to the majority. It's all about utility, it's all about providing benefits, and it's all about being stored and retrievable. Digital assets are stored, they're retrievable, they're on the blockchain, you can use them, and they have utility for the most part, or many of them anyway. Then, if that's well and good, no problem. If you don't accept that premise and you say, no, something has to be physical for it to be a valid asset, then we've again discussed how something can still be an asset from a Sharia perspective. And we say, just like we are all trading in intangibles today, we're all using intangibles today. In the same manner, this is just another intangible. It meets the criteria of property, although it's an intangible. So we call it mal hukmi, not mal haqiqi. It's not a literal real asset or a real property. Rather, it's a legal property. It's something that the law or the Sharia would recognize and accept. And finally, if this is not the case and these two angles are not sufficient or you don't agree, then the entire concept of huquq fits. So this is just a right then. You have a right via your token or digital asset that you hold to utilize something else. You have a right. And this was approved or at least accepted by everybody, the idea of rights. The IOF standards accepts it. Classically, it's a concept. The majority of scholars, besides the Hanafi school, were much more accommodating to the idea of rights being traded. And so these are the three different ways to understand whether digital assets can be deemed property and how they can be deemed property. Okay, so that's all the theory done. Now let's apply what we've just discussed to Bitcoin and Ethereum. So let's look at Bitcoin. So Bitcoin, does it have a recognized value? Is it recognized by people? Of course it does. Approximately over 500 million users of digital assets. And from there, of course, a significant number will be for Bitcoin. El Salvador has approved Bitcoin as legal tender in 2021. So clearly, it's widely accepted, globally traded, used in multiple countries for remittance and for trading and transacting, even though it might not be recognized officially as a legal tender, but people are using it. It's been approved in different jurisdictions for people to own, trade digital assets or Bitcoin specifically. El Salvador has deemed to be legal tender. If that's the case, if one country in the world has accepted Bitcoin as legal tender, then just as the same country has recognized its own currency, and then the entire world has recognized that currency, why can't the entire world then agree and approve that Bitcoin is legal tender in El Salvador, and hence in El Salvador it has value and utility as a legal tender, And therefore, this is just then as any other payment system. It's just another type of payment system. We've accepted the currency of El Salvador. We'll also accept then what they've recognized themselves as a country in terms of BTC. But nevertheless, BTC then, does it fulfill the criteria of it having this utility? We just mentioned it does. It's widely accepted. People are using this as a hedging mechanism. They're using this as a means of remittance. They're using this as a store of value, as just a method of transferring money to perhaps for savings purposes. There are multiple reasons people are using Bitcoin. And so it fulfills the number one criteria, which was people being inclined to it for its utility. Does it have benefit, which we discussed? It does have benefit. Storability, yes, it's stored on chain. So your Bitcoin is stored effectively. What Bitcoin is, as we'll discuss shortly, is you are controlling unspent transactional outputs, or in short, UTXOs. So the ledger has this recorded, and that's what you're controlling. Via your private keys, you have control over this unspent transactional outputs, which you're then transferring elsewhere, which we'll discuss. So it is something that's recorded, something which is separate from myself and from you, and therefore it is existing separately on chain, just like any other software is existing elsewhere. I give you a USB stick and that has data on it, and that's got a file on it. The world acknowledges now that that file is on that USB drive. It exists there in that data. Same thing up here. The blockchain, this software, has this file or this record, which we all then acknowledge, just like how we acknowledge other cloud or any other form of storage which holds data. That alone then establishes Bitcoin having the condition of it being something that people desire, people seek, having utility, and not only that, also being storable and retrievable. So it's already fit the criteria of something being mal. It can also be transferred. I can transfer my BTC to you. Then you'll have the sole access and right to use this without any interruption from me. Hence, from just that alone, it fulfills the criteria of something being mal. And whether you want to call it mal haqiqi, like literal property, akin to physical property, and anything which has these criteria and these conditions is its property from a Sharia perspective, or you call it mal hukmi, or you call it rights, that can also work. How will the argument of rights work? If you want to frame Bitcoin as a right and haq, how does that framing then work? So the way to understand that from a Sharia perspective would be that you actually then hold a right which lives inside a live global system, and that the token is just a handle. The value then comes, you have this right to this software or to this technology which gives you security, incentives, there's an infrastructure. When all that comes together, there's actually a value there. That's what people are interested in. It's not just the numbers on the ledger. This is the one thing which people often misunderstand. When we're talking about Bitcoin and its value, people zoom into, yeah, well, it's only a number on a screen, or it's only a number on a ledger. You're missing the entire point. That number is capturing an entire universe of ideas and concepts which are powering the system. So the value is coming from the system itself, the concept, the ideas that this infrastructure resonates, not just a number sitting on the screen. That's just the output of an entire system which gives you security. There's independent nodes enforcing this and making sure it's operational. There's no single point of failure. There's a credible policy and fixed supply of this, 21 million fixed. The idea resonates with people. Likewise, people have self-custody. They can use this as they want, when they want, where they want. There's a network effect and infrastructure supporting the development and growth of this asset. Everybody has skin in the game. It's these ideas, and the idea that it has practical utility it can be used 24/7, 365 days across the year in almost any country where you have access to and is permitted to use. You can use this particular asset, and it's international, it's cross-border, it's not restricted to one particular location, it's borderless. All these ideas give this thing value, and you have the right now to effect a change in that. And that's where the right comes. You have that right to do this. So if you want to understand Bitcoin from a rights perspective, that's the way to think about it. Now let's look at a real case study of utilizing and using Bitcoin. Just say you want to use Bitcoin as a remittance method where you want to send money to somebody overseas. Just say, so I want to send money in Malaysia, for instance. If I used off-chain transfer facilities, it cost me perhaps £7 to £15 in the UK. That include the transfer fee, the FX markup, and other fees in the interim that are paid to the corresponding banks. In terms of speed, it can take anything from 1 to 4 business days typically. It can be longer depending on what's happening. The operational hours will be subject to bank cutoff times and business days. The FX rate will impact the overall fees. In terms of transparency, I will not always have insight. I'll have to contact somebody else to work out what's happening. Is it reversible? Yes, that's an advantage and bonus. And finally, there is compliance rails there. So I'll have to make sure that the compliance checks are all. Let's look at a transfer on-chain. If we use Bitcoin rails, for instance, and we're sending the same amount of money to Malaysia, but via Bitcoin rails, what would that then include? I'd have to convert my currency into Bitcoin and send that Bitcoin across, and then they would again exchange it back. There could be some transfer fees there, but typically the total cost, you're looking at somewhere between £2 to £3 and perhaps slightly more, depending on the network fees that are associated with the digital assets. But yet already we can see a significant difference in the pricing of just the cost on £100. In terms of speed, it can take anywhere from 10 minutes to 60 minutes, whereas previously we're looking at an off-chain transfer taking up to 3, 4, 5 days possibly. In terms of operational hours, this is operating 24/7, 365 days across the year. Settlement is happening every single day and almost every single minute. There's spot markets available. A public ledger is visible to see and audit and trace. Yes, the downside is it's irreversible as opposed to your off-chain transfer. And there is a price risk and also compliance-wise similar, but there'll be separate regulated on-ramping, off-ramping compliance criteria that you'd have to fulfill. So already you can see some added benefit. There is a clear benefit in using this digital asset to transfer some funds overseas to somebody else. Maybe your relative somewhere needs funds immediately for an operation. Maybe there's been a flood, or there's been a disaster, or somebody's passed away in the family. And if you wait 3, 4, 5 days, then you will not be able to fulfill the immediate need. Hence, this allows this to operate and fulfill the need immediately. Another obvious benefit and use case is hedging inflation risk in many countries where inflation is rampant and is perhaps hyperinflation. If a person in such a country held their wealth and hard-earned labor and reward in the form of Bitcoin, that would then hedge against the inflation, and it would prevent their sweat being diminished in front of their eyes and the hard labor being diminished in front of their eyes, because the Bitcoin would store their value and perhaps even increase the value of labor and work. So hedging plays a significant role in many countries where if you were to keep the currency in hand after 1, 2 years, then you may lose 10, 20, 30, even 40% of its value in real terms. It might stay the same as a 10,000, but in real terms, it's only worth now 6,000 or 5,000. So hedging is a key benefit in many countries where unfortunately there's high inflation and people's wealth and labor is being impacted by the inflation. So that was the key discussion I just wanted to present on Bitcoin and understanding Bitcoin, making sure that we can see the Sharia discussion and how the Sharia analysis is. When we focus in and zoom in on Bitcoin, then just very simply, Bitcoin is the native asset of the Bitcoin network. And Bitcoin is a base layer blockchain. So that base layer, the layer one, is responsible for, or its function is to record transactions. That's what it's doing, to keep a receipt and record of everything. You can think of Bitcoin having two data sets. One, the blockchain, which is where the append only history, and the other one is a UTXO dataset. So when we're transacting trading today, we are dealing with this dataset, but then everything is attached then to the historical record and trace of the blockchain. And when I'm sending a transaction via Bitcoin, what am I doing? Well, every UTXO, unspent transactional output, that I am commanding with my private keys, that really consists of two parts. So the UTXO has an amount in there as well as a locking script. When you engage with that UTXO through your wallet and your private keys, that provides the unlocking script. You unlock this and you give a signature. That signature then is transmitted to all the nodes, they approve, and then the transaction is then processed. So effectively, through this wallet and the private keys that you have, you are now commanding control, possession over the unspent transactional outputs, or the Satoshis and the individual Bitcoin units, and you are able to spend them when you satisfy and you fulfill the locking script criteria by giving the unlocking script, by providing what's required as far as the public key is concerned and the signature is concerned, and then that enables the rest of the operation to begin. So that's the technicalities behind a Bitcoin transaction. So that's everything to do with Bitcoin. What if we apply the test of something being mal, an asset, from a Sharia perspective to Ether, which is the native asset of Ethereum? Ethereum being this programmable blockchain which runs smart contracts, which is extremely useful for building decentralized applications. How do we understand Ether? So again, same thing. Ether has benefit. People are inclined towards it. People use it for running smart contracts, paying gas fees on Ethereum. And Ethereum as a software is extremely powerful because that's where everything is being built. So it fulfills the criteria of mal. You can call it mal, a proper asset. You can even call it mal hukmi because again, it meets all the criteria. And if you want to frame it as hukuk and rights, then Ether, the native asset itself, can also be deemed to be hukuk because it gives you a right to access computation. It gives you a right to transfer and settle value on Ethereum. It gives you a right to power smart contracts. So these are all things which are recognized, are stored, retrievable, and this Ether and Ethereum has its own balance and its own accounts. You own Ether as part of those accounts. That's yours, which you'll have access to. So again, the idea of storability, retrievability are also found and met. That was all to do with intrinsic issues with digital assets. We looked at intrinsically, is this an asset? Does it have utility? Can it be used? What's actually happening on blockchain? What is happening on chain? Is it being transferred? Is it being stored? Do you have access? These were the questions we were asking in terms of the essence of the asset. What about the extrinsic issues then? Because when we're analyzing something, there'll be intrinsic issues and extrinsic issues. So the first extrinsic issue which people raise as an objection to digital assets is that this cannot be called a currency. Now, the problem with this framing is it's a misnomer. The word cryptocurrency is a complete misnomer because these things are not currencies. Nobody deems them to be currencies. Nobody deems them to be fiat equivalents. Rather, these are just payment tokens, just like I can walk into a store and offer the shopkeeper, I can offer him a bar of chocolate to buy something. I can offer him a gold coin and he can accept. In the same manner, I can offer him a digital asset. If he accepts it, well done. If he doesn't accept it, not a problem. I can pay him in legal tender. So this digital asset or any digital asset is not an equivalent to fiat money. Nobody's deeming it to be currency in the way we conventionally understand currencies. And that's why this question doesn't even come to play, because you can have payment tokens in different networks which are not money. Just like how you have payment tokens on games. People have coins and different in-game items that they can use to pay and buy things. This is recognized by everybody. Everybody does this. All games make this. But nobody debates or argues whether that's a currency. That's just a virtual token. In the same manner, this is another virtual token which operates on its own network, and it's down to the counterparties to agree, accept whether they want to use this particular method to transact value. That's the discussion. And from a Sharia perspective, to be accurate, besides gold and silver, the other assets were also accepted as payment systems and payment methods. That's why we have the hadith and narration on Riba al-Fadl, where the hadith mentions 6 commodities besides gold and silver. You have dates, you have barley, you have salt. These were also mentioned in the hadith, that these cannot be traded. And they have to be, if you are trading like the same asset, it have to be equal, like for like, and hand to hand, immediate transfer and immediate settlement. Why? Because these were commodity money. They could be used as payment systems. So anything that has a possibility of being used as a payment token, payment system, can be used as a medium of exchange without calling it money. Nobody would call the commodity monies dirham and dinar or proper currency, but it was something that was plausible because of its features. It was storable, divisible, retrievable, countable, something that could be, it was durable. Hence, people would use it sometimes in petty transactions in the outskirts and villages to make settlements and make payments. Hence, the same idea would apply here, that nobody's calling this a currency, and there's no need for it to call it a currency, really. Rather, it's just another type of asset which can be used for payments as well. A second objection that's typically raised is the idea of a lack of governance for digital assets, that there is no regulation or regulators have not approved it. That suggestion and that argument no longer really stands, because as we see in the world, multiple regulators are now adopting, reviewing, accepting digital assets, and they are creating frameworks, granting licenses, like you have in Europe, the MiCA, you have in UAE, you have VARA. You have multiple approaches now in regulating digital assets. So regulation now is becoming the norm with digital assets. They are being accepted. So there is already some layer of governance. And in fact, if that's off-chain, is also governance on-chain, because on-chain you have hard rules which force all the nodes to operate in a particular way. So there's already governance built in on-chain. So the fears that we have of on-chain fears, many of these fears have been dealt with, the rules have been hard-coded and hardwired into the protocol itself. So that's why the governance objection does not really stand the test anymore. And these are, as I mentioned, when it comes to digital assets, you're seeing more and more regulated platforms. When you're on-ramping and off-ramping, when you're exchanging, transferring, all of this is now being regulated. So there is a very strong layer of governance being built around the transacting and trading of digital assets. A third objection that's raised against digital assets is the concept of speculation. Many people say digital assets, it's speculative activity, speculative behavior, and therefore it's gharar. Speculation and gharar are not the same thing. Gharar refers to when there's uncertainty in a contract. When there's uncertainty in a contract, in the sense that a contractual clause, a contractual condition is uncertain, is contingent on something. That's gharar. But speculation is you just taking a view on the movement of price of an asset. That's all you're doing. So if I'm speculating, I'm taking a view on the price movement. Now that happens in Sharia-compliant assets as well. I can invest in a Sharia-compliant asset like stocks, which are Sharia-compliant, and speculate on the price movement. That'll be speculating. But does that speculation make the underlying asset not Sharia compliant? Of course not. So gharar and speculation are two different things. Speculative behavior, it's a different issue. In and of itself is not a problem. In fact, all business endeavors are known as speculative risks. If you look at insurance law, there's pure risk and speculative risk. Speculative risk covers business, trading, investments. And insurance does not cover speculative risks. They only cover pure risk, because the idea in insurance is to make you whole again. If you've suffered a loss, to bring you back to where you were before that loss or peril occurred. Hence, speculation is not really an objection. And even if somebody wanted to look into this further, data shows that approximately 45% of Bitcoin supply hasn't moved in the last 3 years or so. So people are clearly not, almost half of people are not using it as a speculative asset. The data shows they're using it as a store of value now. People are holding on to their Bitcoin. Nobody's trading it widely and speculating. And that takes us to the fourth point, really, about volatility. Bitcoin, is it really volatile as it was in its early days? Which was expected. It was a new asset. People were seeing gains. People are seeing opportunity. And that happens. In anything new, there's opportunists. But here, empirically, Bitcoin's volatility has trended down over time. It's no longer the big swings that we were accustomed to and seeing 10 years ago. That's not happening. Rather, it's only fluctuating in a very small bracket of pricing. So, if that's the case, the volatility has definitely reduced. But does volatility itself make something not Sharia compliant? That's the real question. The answer again is no, because if you look at startups, startup investing is extremely risky. In fact, there's data to show that 90% of startups fail in the first couple of years. If that's the case, being so volatile and so risky, would anybody say investing in a startup is not Sharia compliant? Of course not. Volatility is not even the criteria to screen from a Sharia compliance perspective, neither from the IOP standards or any standard whatsoever. It's just something that we would discourage people to be heedless or people to be negligent about, and to be more prudent on how much they invest and how they allocate and budget. But that's an individual decision, and as regulators, as from a governance level, we can guide people and make sure that consumers, investors, traders know how much risk to take, and we look after their rights and inform them and guide them to what's best for themselves. But volatility is not a criterion within the Sharia screening at all. Hence, startups, even though majority fail, as long as the startup is Sharia compliant, its financials, its business, it's Sharia compliant, the scholars will still say it's Sharia compliant to invest in a startup. Likewise in penny stocks. Penny stocks, again, very volatile, yet the same analysis occurs. We're looking at the business, its utility, we're looking at its financials. If it meets the Sharia screening criteria, we'll say it's acceptable, regardless of its volatility. So volatility, again, is not a deal breaker, and it's not something which can be sufficient as an argument to deem digital assets as not Sharia compliant. The final objection that's typically done against Bitcoin and digital assets in general is the illegal use of digital assets. Well, to be honest, Chain Analysis, they did a survey and review and research which estimates back in 2023 that less than 1% of digital assets were being used for illicit activity or illegal use. So the on-chain flow, less than 1% of that was being used in illegal avenues. Now, that reality is happening in every other currency as well. So we have to target that and make sure that doesn't happen, that funds are done and used in a legal way, in a proper way. So there's criteria, frameworks to ensure that. But that doesn't make the actual asset non-Sharia compliant. Just like, for instance, if somebody was doing illegal activity with sterling, with dollar, with euro, with yen, or any other currency, we wouldn't deem the asset or currency as not Sharia compliant. We would deem the activity as problematic. So the same thing and the same logic applies here. So hence, that's not really a strong argument. There's frameworks, methods, governance, and more prudent methods and measures to tackle that issue, as opposed to saying the actual asset is not Sharia compliant. So that was everything to do with understanding how digital assets can be considered valid assets from a Sharia perspective, and then looking at Bitcoin and Ethereum, and also understanding the extrinsic objections on digital assets. Now, I just want to share with you the facet screening guidelines and criteria that we've developed with our Sharia in-house intelligence, our expertise across our team in tokenization, in finance, in tech, and digital assets. We've developed a industry standard, institutional level Sharia screening for digital assets. And there's 5 layers to this. Level 1 looks at the base chain, which is the layer 1 effectively. What's the base layer or layer 1? That's the foundational chain where transactions are finalized. So at Facet, what we do is we ensure the foundational chain is neutral. So for instance, blockchain, Ethereum, these are layer 1s, foundational chains. Our focus is this neutral? Is it doing anything specific for a prohibited activity? Is it designed for a prohibited sector? Is it economically dependent on a prohibited sector? If that's not the case, then our initial screening for a layer 1 screening is a pass. Because up here, we're just concerned with what the base layer or layer 1 is actually achieving and doing, and that's on chain, what it's actually achieving. The second level is the layer 2 screening. So certain chains are layer 2s. So if we're looking at a digital asset of a layer 2, we'd start from the layer 2 itself and understand that layer 2 is a scaling network that helps settle transactions to the layer 1. It's to do with executing transactions off chain of the base layer and then anchoring it back to the layer 1, which is beneath the layer 2. So we review the layer 2 with the same idea, that is this layer 2 neutral? Is it general purpose? Because if it's general purpose, then the layer 2 or layer 1 cannot be deemed impermissible in and of itself. Rather, the impermissibility will be ascribed to the user and how they use the asset. Like any tool, if you use the internet in a lawful way, the internet is neutral. You can use it in a lawful way, unlawful way. You can use a knife in a lawful way or an unlawful way. That's down to the user. So the actual tool is neutral. Likewise, we test the neutrality of the layer 1 and layer 2. If it's neutral, then any prohibited activity will not be ascribed to the protocol or the base layer or layer 2. Rather, it'll be ascribed to the user themselves and what they're doing in the activity in particular. So we look at the layer 2. Then level 3, we're now looking at applications and the protocol level, because it's here now where smart contracts are building applications, or smart contracts are used to build multiple things on the base layer. So these smart contracts sit on top of base layers. What we're looking at now is, what's the core business up here? What's the mechanism? What are the rights? How is it functioning? If it's an automated market maker, what is it doing? What are its key business activities? Is it a lending market? Is it a decentralized exchange? Is it a real world asset? Is it staking taking place? These are the types of applications built upon your base layer, your L1 and your L2s. And so these, you could say, applications, these decentralized applications, are operating via smart contracts and built on top of these layers. We check now on the business activity, the financials, what it's doing, what's happening, and the core activity. Is this, again, neutral? Or is it specifically designed for something which is not Sharia compliant and providing non-Sharia compliant benefits and services? That's the third level of screening that we do. The fourth level of screening is we look at the token utility. What utility is this token actually providing? Is it providing any genuine on-chain or off-chain utility? Because if it's not providing utility on-chain or off-chain, then really it can't be mal. Again, circling back to our original conversation and discussion, it cannot be an asset. because an asset from a Sharia perspective is all about value adding. It's all about exchanging value, transferring value. But if you have something which is not providing anything, rather people are just like some meme tokens, people are simply trading them on exchanges looking to make some quick profit. But it has no value at all, no benefit. It's just a white paper saying, hopefully it will be this, it'll be that, it'll be the other. But there's nothing that is doing really in on chain or off chain. And it's only being traded right now on markets. Then just being traded alone is not a sign of it having acceptance and approval. It has to be providing some genuine benefit. People should be using that for something, either on chain or off chain. But there should be some benefit. Either on chain is actually giving you faster transactions, which people seek and desire, or settlement times are faster, or it's created a different way of consensus, which is appealing and interesting to people, or it's providing some kind of networking effect. Or off chain, you're using it as a hedge, or you're spending somewhere, you're getting access to services, utilities, benefits, like certain tokens do. But if a token is not giving you any of these utilities at all whatsoever, and it's purely being traded for the sake of just gaining profit, then the very question of utility is missing. And from a facet perspective, we definitely downgrade such a token and perhaps even deem it to be not Sharia compliant. So for us, the asset utility test is a major test that we do on every single digital asset. And then the final test is, once we've gone over the layer 1, the layer 2, the application, we've looked at the token utility, we then look at finally categorizing the token. We classify the token. What type of token is it? Is it a governance token? Is it a utility token? Is it a payment token? Is it a security token? Or is it a tokenized asset? What type of token is this? Because that then helps us build the Sharia frameworks and Sharia principles around certain digital assets. And those are the key layers when it comes to the facet Sharia screening that we do in-house, making sure that every digital asset fulfills all of these criteria from a Sharia governance perspective. To end this session, let's apply that screening criteria now to 2 digital assets and see how our facet, we've looked at these 2 assets to understand them from our own screening criteria. So let's take the example of Filecoin or FIL, F-I-L. What is Filecoin? Filecoin is a blockchain that runs a decentralized cloud storage marketplace. That's the core business. It's providing decentralized cloud storage. It's a marketplace. So people can go and access cloud storage on this marketplace. Now that's a genuine utility. People want, people seek. People want storage online. So what did we do? We took the layer 1 screening. Filecoin has its own layer 1 and base blockchain and its own foundation. So it's not built on Ethereum or Solana or something else. It has its own layer 1, and we looked at that separately. Again, from our perspective, when we screened it, there is nothing in there. It's neutral. It's just there to capture these transactions, ensuring the movement of the Filecoin or the FIL coin. And in addition, it has its own chain, its own asset, its own consensus mechanism, its own block producers, and the native token as well. So as a layer 1 screening, there's nothing there which deemed it to be non-compliant. This was a permissible activity. Layer 2 screening, of course, there is no layer 2 involved because this is a layer 1. So there was layer 2 screening was not applicable. When we looked at the application and protocol level, then Filecoin, the L1 itself is the very application. The layer 1 is the decentralized storage and retrieval market. So that is the application. So there was no separate application screening required because the L1 itself is also functioning as the application. It's the chain which coordinates storage deals, verifies them, pays providers in the coin itself or the token, and ensures the governance of the entire cloud storage marketplace. So that's the 3rd level and layer. Then we looked at the token itself. That is a token actually providing utility. And it was very obvious that it was because people were paying for storage. People are providing storage and people provide storage in cloud space, and they are compensated with this token. So there's a genuine utility and benefit. I can access cloud storage through buying and paying using this particular token. So it's used for paying for storage, for retrieval, for gas on the network, and therefore it has a real, excisable, usable utility. And finally, the fifth analysis that we did when it came to our screening was its classification. We classified this as a utility token, and therefore we do not treat it the same as a currency or a payment token. Rather, it's a utility token. It's not then given those rulings which might apply to payment tokens. And so our internal screening was that it's past the layer 1. There was no layer 2. The application itself is the layer 1. And utility and the token itself are all fine from a Sharia compliance perspective. And it was deemed to be a utility token, which is Sharia compliant. Hence, it was then listed on Facet. So we do this entire step-by-step analysis internally with the team. We have our Sharia department and the different expertise from different experts within the wider team coming together, analyzing tokens one by one, making sure that we've looked at every single angle before any asset is listed on Facet. It must go through this screening, these 5 levels and layers, which is done for every single asset on Facet. Let's take a second example. Let's look at the famous digital asset called Solana. Now, what is Solana? Solana is a public layer 1 blockchain and is built to process lots of transactions quickly. So the idea is let's process lots of transactions quickly and cheaply as possible, meaning it's designed for high throughput and low latency. That's effectively in crypto language. That's the whole objective and purpose of Solana. We put it through the engine. Layer 1 screening. When we looked at layer 1, Solana has its own chain, its own asset, it's its own layer 1. It's not built upon a base layer. Solana itself is the base layer. It has its own independent consensus model. It has its own large validator set. And likewise, it has its own native token. So it's neutral. There's nothing specific in Solana designed for a prohibited sector, for a prohibited utility. So it passed our layer 1 screening. In terms of layer 2, that's not applicable because Solana is a layer 1. If we look at level 3, which looks at the application and protocol level, then Solana's base layer is the general purpose application. It is that which is supporting the activity of Solana. Yes, things can be built on top of Solana. It allows an environment of things to be built, but then we look at that as a separate smart contract, separate token when we're analyzing that particular token. Solana itself, it's absolutely fine in terms of its operations. What about level 4, the token utility test? Then we looked at Sol, the native asset of Solana, and we realized that Sol is simply being used to pay transaction fees and to stake with validators. This is absolutely fine because if you want to run a smart contract, you want to build, you want to do anything on Solana's network and base layer, you have to use Sol. And that's the gas fees. So you're using that to power the system and to compute and to run effectively the computer. So it's a work for pay model, effectively, not something that's a Riba-based system at all. And finally, we look at the token classification, which was, again, Solana was a utility token and a payment token within its own system, but most of a utility token. It's there to provide utilities access to the ability to run smart contracts and execute transactions on the Solana network. So if somebody wants to build an application on Solana or wants to use Solana for high throughput, low latency, they will do so using Sol as a token, and it provides that service and benefit. So that brings us to an end to episode 1, where we looked at everything to do with digital assets from a Sharia compliance perspective. We looked at initially 3 different ways that a digital asset can be considered Sharia compliant from a Sharia lens. We looked at how it can be just deemed to be mal like everything else, or it can be legally in the ruling of mal, what we call mal hukmi in Arabic, or it can be rights. And all of these are valid ways to interpret digital assets in today's day and age. Then we looked at objections, extrinsic objections against digital assets. We talked about how people use objection of currency or governance or speculative behavior or illicit use. These were all objections, and we gave the answers to every single one, explaining how these objections are not real objections, and rather there's much more stronger governance, perhaps, that can be applied to digital assets than we think. Then we shared the 5-level Sharia screening that we adopt and utilize at Facet, where we look at the base layer, the layer 2, the application, the token utility, and the token classification. And then we went through 2 examples of Filecoin and Solana. I hope this session was of benefit to you and this episode was enlightening for yourself. Join us for the next episode where we'll be talking and diving deep into another area within the cryptoverse, exploring and explaining the Sharia principles of how to navigate the other areas of digital assets. Assalamu alaikum wa rahmatullahi wa barakatuh.